Welcome to Yield Nerd, an educational show about how you can acquire and manage yield. All right, Chairman Powell has given his decision, a 0.25% increase in rates, and the message that we may be close to the end of rate hikes. What does that mean to us? Does it mean it is time to pivot to equities and no longer be in fixed income? That is the question we'll try to get deeper under. My usual disclaimers, this is not investment advice, it's education. You make the decisions. I am not a wealth management advisor. I do not have sponsors, so any recommendation, anything I pitch, it is what I believe in. I wasn't paid to say that. All right, here is how we're going to organize this. First, we'll look at what 2023 has brought for fixed income. Then we'll look at equities. And we'll sit there and gather some data around how do you make the pivot decision? Is this the right time to make the pivot decision? Understand the basics of value investing, some macroeconomics that play into it, and figure out where we go for the next 90 days. Before I proceed any further, if this topic is a little too much in the middle for you, please remember that there is a playlist for the show. It organizes every single one of the 55, 56, how many ever episodes so far in numeric order, so you can follow it. The link to that playlist is right here, so feel free to use that and come in the order so you're not jumping in between. Okay, we have in prior episodes used the concept that I call the Yield Superbowl, where we compare every fixed income instrument, a CD, an agency bond, a treasury bond, a muni bond, and a corporate bond, and say for each duration, what is the right decision? What should you do on a tax adjusted basis? And what we learned is that the tide indeed has turned, and we have in our hands a very unique situation where bank CDs are the best investment purely for yield for the next 3 months. And thereafter, agency bonds take over. That was the decision or the status a couple of weeks ago. It continues to be the status today. And where we have seen a lot of the momentum go is that treasuries have indeed crashed, meaning the market expects the Fed to no longer aggressively increase rates. And the Fed itself has given mixed signals. And so treasury yield has not really picked up. We also have that fiscal cliff we talk about. For all of those reasons, our horizon is pretty much 3 months and not much else. And for the next 3 months, CDs were the winner. And pretty much if you only compared CDs and treasuries, treasuries have crashed and burned, and CDs in the ultra short duration are good. However, I don't know that any one of us is going to buy really long-term CDs only because, again, with the fiscal cliff looming, the thought is to keep cash handy and figure out what happens in the middle of the year. And so given that we've had a 25% correction in long-term yield, what did the FOMC say lately? Chairman Powell gave a very clear message. The very clear message was that it is too soon to tell whether we should be increasing rates or not. We may have less work to do, but we don't know. That is a very definite maybe end of rate hike, potentially likely later this year kind of thing. So it's and you know, the FOMC cannot exactly telegraph how many more interest rates hikes are there, what they're going to do, but he's pretty much saying, you know, earlier in the year we thought we were going to have to pursue the path aggressively. We're still going down the path of increasing rates. We just don't know. There is too much noise in the market. So having said that, what has 2023 brought for equities? We saw fixed income has crashed and burned. Well, before we answer what equities have brought in 2023, maybe I thought we could stop back and say, when you buy a stock, what are you really buying? So you are buying the rights to a percentage of the cash flow of the company. Meaning, if a company throws off $100, and when I say throws off $100, that is its operating profit. And they've paid their interest, they've paid their taxes, and you know, maybe some of it is dividends, some of it is just profit that is sitting on the books. So the company generates what is called free cash flow of $100. You say, I will buy 1% of the rights to that money for the next X years. In theory, the price of a single stock is the price of the rights to the future cash flow of that company. That is what you're buying. So you may say you're buying the company, which in some sense is true. If you bought voting stock, I suppose you control the direction of the company. And if you really are buying such a large percentage of the company and you're using Yield Nerd as a guide, you got a problem, not me. But if you're buying a much smaller percentage of the company, then what you really are doing is buying the rights to the future free cash flows of the company. So here is a simple example. The opportunity cost of money is roughly 5% because you can put money in treasuries and make 5%. If somebody came to you and said, I will give you $100 every year for the next 3 years, meaning I'll give you $100 after 12 months, 24 months, and 36 months, how much would you pay to get that? If you answered $300, you are wrong. Because the first $100 doesn't even come to you until 12 more months. The second $100 doesn't come to you until 24 months and so on. And your money could go to work today at the 5% interest. So the way to think about it is you would pay $95 for the first 100 that you're going to get in 12 months. But for the second 100, it's 24 months out, you would only pay $90. And the third 100, you would pay $86. This is the opposite of how you think about a T-bill. You buy the T-bill at a discount, and you then say, I will take the par value at the end of the term. Here, you are paying that upfront, and you're getting the coupon every year. And that's really the way to think about a stock. So if there was a company that hypothetically only existed for 3 years and it threw off $100 in free cash flow for every share that you owned, you would pay $272. Anything higher than that in today's market, given the opportunity cost, is a poor, decision. Anything lower than that, pretty good. So that is really what you're buying. Think about that as what you're buying. And the reason I give that big lead up before I look at the data for equities is when COVID was not even on the radar, January 2020, nobody was worried about it. Interest rates were 1.5%. Inflation was 2.5%. Arguably, the economy was extraordinarily strong. Today, interest rates are 3 times higher. Inflation is almost 3 times higher. How much would future cash flows be worth now? The correct answer should be less than they were before, meaning owning the rights to the same future cash flow should be significantly less valuable today than before. Owning the rights to even a greater cash flow should be worth about the same or less, except when you look at the Dow, what you see is that pre-COVID, the Dow was at 29,000 something. Today it is at 30,000, 32,000 something. What that means is allegedly the market believes that the industry is 15% more likely to give you the bang for your buck today with healthier cash flows than before COVID. You do the math. You tell me whether you believe the value portion, the Dow, is correct. What do you think the NASDAQ is going to say? Same question. Now remember, NASDAQ companies are more growth oriented. And so were the prospects of a NASDAQ company higher before there was a COVID, or are they higher now? And at a higher inflation rate, when it is harder to raise debt, the answer again appears to be that given today's valuations, apparently the market thinks that companies are 20% healthier. The reason I show this to you is to kind of point out the inconsistency, even with all of this crash from this peak of 16,000 to where it is right now, which is around 11,600. Even with that, the common sense way of looking at it does not necessarily add up. So There is a famous proverb that says a bird in the hand is worth two in the bush. And that applies a lot when you look at stocks. And here is why. People could sit here and say, you know what? All you need to do is buy stocks. You could buy it one day before the Great Depression of 1929 and lose 30% one day later. If you just waited long enough, look at this amazing thing. All you need to do is wait for 40 years and your money would be worth 27 times what you put in. Don't do any investigation. Just close your eyes and buy stock. In other words, all birds will eventually sit on your hand. Forget about having birds in your hand. Just go for the birds in the bush. That is the argument that is being made, and the support that is being given is that the stock market always goes up over a long period of time. You don't have to worry about anything, just go buy. That is one side of the argument. But if I'm a yield nerd, which I am, I would ask a different question. How do I know that there are two birds in the bush? Because maybe there aren't two birds in that bush. How do I also know if those two birds are going to come into my hands? Maybe there are two birds, but when I go close, maybe they fly away. And then there is this one thing that is going to happen in July, September, June. We don't know, some kind of a, liquidity event with debt ceiling. I'm going to call it July 4th fireworks. And if there is that kind of loud noise, wouldn't all the birds in the bush fly and there would be a lot of, discontent in the bird market? In other words, to say that we should just jump to equities on any day and if we sat around long enough, everybody will win because history says that, with great humility, doesn't appear to be a solid argument given where we are today. And here is the first part of the July 4th fireworks, and this is not politics, I'm just giving you data. Here is one side that says, I'm not going to negotiate. Here is another side that says, well, why don't we pay some bills and not pay other bills? And given how far they are, it appears that somewhere between July and September, there will be a cliff. Nobody is worrying about averting that cliff. We are going to approach it. It will cause turbulence in both equities and in fixed income. What does that mean to you, and what is the best next step? There may be an opportunity to pivot, but you need to know where to pivot and when to pivot. And one possibility is to sit in cash right before the fiscal cliff hits. If yields crash, then you go to equities. If yields don't crash, well, interest rates are high, we've not started dropping interest rates, then maybe sit on short term. To execute the strategy of going to equities or not going to equities, you need to know which equities make sense and how to invest in healthy companies with solid cash flows. And that is what I thought I would start talking about. It is still yield investing, it is not growth investing. It is investing in the rights to future cash flows. And so value investing is really the sibling of yield investing, where we make the conclusion that we are at the beginning of the end of higher and higher fixed income. Some would argue until inflation comes to 2%, it will always go higher. We're not jumping a la carte. Even if you believe equities are overpriced, is there an opportunity to understand which segment of equities have good dividend possibilities, good capital appreciation principles, and sit and wait until the debt ceiling discussions are over? That is what we're going to do. And to analyze financial stability of companies, I was going to start with something very basic. Here is Sally. Sally lives in a home that has a market value of $200,000. She has paid off $120,000 off the mortgage she had. The remaining mortgage is only $80,000. Sally is a very frugal young woman. She saves $20,000 a year. She has $80,000 in the bank account already, and her credit card bills are $250 a month. Is Sally financially free? If Sally was related to me, or if Sally asked me for advice, I would tell her, Sally, you are generating a very nice annual savings. Just start paying off that mortgage. You do have a cash cushion that can take you through several months of your expenses. You are living frugally. And so keep managing your finances the way you are doing, get out from that debt, and you have a lovely future ahead of you. Good job, Sally. Well, let's talk about Bob. Bob lives in a home that is worth 400,000. Bob has paid off some of his mortgage, but he has a really big mortgage balance left, 320. Bob also saves $20,000, but he doesn't have a lot in his bank account. Bob's having fun spending a lot of money. And also, Bob's credit cards have a much higher balance. Is Bob financially free? What happens if Bob loses his job? How is Bob going to cope with it? Bob has a long way to go with his loans. He can't pay off his loans through his bank balance. It's not strong. His spending is too high. And also, he really cannot take big risks because the attack could come from anywhere. This simple example can be applied to corporations, meaning we can look at the cash flow of a company and say the operating cash is kind of like the savings, if you will. The company makes money the same way the person makes an income. They spend money on certain things and then they have a savings. Estimating how much more they would make over the next few years, you can come up with a present value of future profits. The company has X amount of dollars in the bank account, and they may or may not have debt. To compute the total value of the cash flow of a company, you would just say, I'm going to take the present value of the operating cash flow. The cash in the bank is a good thing. I'm going to add that, and I'm going to take out the present value of debt. So that really will tell you how strong a company is. And the inverse of that will also tell you what company is likely to be acquired at a premium, or what is the buyout value of a company. Let's talk about that. The value of a public company would be the current share price, which you can argue is too high, but you do the math. If a company has 10 million shares and each share is worth 20 bucks, the market cap of that company is 200 million. A company with 200 million in market cap that has 20 million in cash and debt of 2 million, step back and say, how much is the company worth? If you try to go buy this company, presumably nobody knows you're buying 100% of the shares, but let's pretend they don't. You would spend $200 million buying all of their shares. You're out 200. Oh, wait, you had to pay off their debt as well. Now you're out 202. And then you say, whoa, a little bit of relief. There's 20 million in the bank. And so you're really out 182. At that point, you have a cash-free, debt-free company that you can operate, and it generates operating profits. In other words, the takeover value, and there is a different terminology to this, we're going to look at that in a second. The takeover value of a company is the market cap plus debt, because you have to pay off the debt, minus cash, because you get to take the cash off, and that would be what you would pay. The fancy word for this is enterprise value. So in this scenario, if the stock price were to decline, the buyout is cheaper, because presumably if the company is only worth 180 now, you can spend 180 and buy all their shares instead of 200. If they have more cash in the bank, all the better, because once you're done buying them, you can get a bigger cash balance out of their bank account. If they are in debt to a greater extent, then you have to pay off a bigger number. So looking at a company, kind of like you look at a person, the future cash flows, cash already in the bank, and debt gives us what is called enterprise value. And if you then were to overlay enterprise value on macroeconomic considerations, such as in the next 6 to 9 months, if you believe the market is fair today, forget about seeing this. In all likelihood, when there is a debt ceiling scare, market caps will come down. So you will have to, in this scenario where you're the person trying to acquire the company, or you're the person trying to acquire stock, you will spend less to own that company. Cash flows are likely to be lower. Debt is likely to be higher. And so in theory, you should have stronger enterprise values, greater opportunity over the 6 to 9 months, and there may be ways for you to sit out and identify those companies and do nothing right away, but sit and wait. The best of available options, if you want to think of it for the next 3 months, is if there is a severe disruption in the economy in 3 months, what would the general population still need to buy, whether or not they have a job, whether or not the banks work? If you looked at the grocery store line one day before the Silicon Valley Bank crash and one day after, was there a change there? If you looked at the luxury car dealership, was there a change there? Those are the ways you want to think about what are things that people have to buy, whether or not there is a disruption to the economy. What are things where a small change in the price? There may be things you use on a daily basis and you pay $1 for it, and now it's $1.10. You're not going to notice the 10-cent price increase, but the company that offers it now has a 10% increase in their revenue, which in all likelihood goes straight to their profit. And so that's really what you want to think about. Where is the opportunity for enterprise value? And we're going to spend the next few Yield Nerd episodes creating a model to understand the financial health of a company, identify fixed income opportunities or corporate bond opportunities of the same kind of companies that are likely to be financially stable even if there is a blip in the economy, and step back from there and see where to go. So what does it all mean in the next 3 months? The proverbial ice cream we talk about, the short-term federal treasury market that used to pay 5+%, that is melting. The medium term is not even available. It is sub 3.5%. What does it all mean? For now, yield nerds may still want to only sit on short-term treasuries and wait until the middle of the year. Let us learn about value investing, do our homework, keep our models ready, and wait for the middle of the year and go from there. Thank you for listening to Yield Nerd. Let's pick up on value investing. Have a nice day. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.